Trillions of dollars are quietly getting trapped inside a system most people don't even know exists, and the warning signs the world is sending are getting harder to ignore. So, what's unfolding today could become the trigger for the next financial crisis, one that could be even bigger than 2008. And here's why I'm saying that. So, behind the scenes, some of the world's most powerful financial firms like Blackstone, BlackRock, and Blue Owl are deeply involved in something most people aren't even paying attention to: the private credit market. And on the surface, everything looks stable, but underneath, there are cracks forming in the system. Cracks that have the potential to spread fast. At the same time, global tensions are rising, oil prices are surging due to the Iran-US war, adding even more pressure to an already fragile economy. And it doesn't stop there, job losses are increasing too. Inflation is still a major concern, and over 92,000 jobs were lost in a single month, that's February. So in this video, we are going to break down what's really happening and why this could be the start of something much bigger than people realize. But before we begin, let me introduce myself. So I am Jack Cross, and on this channel, we connect what's happening around the world to the economy and financial markets. So let's get into our main topic. And now, to understand how private credit markets could trigger a financial crisis, we need to go back in time, back to 2008, because that's where this story really begins. The private credit market grew from almost nothing to over $3.5 trillion in just a decade. And that growth was largely a result of what happened during the 2008 financial crisis. That crisis wasn't caused by just one thing. So it was a chain reaction of multiple factors, but the main trigger was subprime mortgages. So in simple terms, banks gave home loans to high-risk borrowers, people with low income and poor credit. And at first, everything seemed fine. People could afford the payment, but not for long. When interest rates started rising, millions of borrowers could no longer repay their loans. That leads to default surged and housing price collapsed. And this is where the system began to break. Banks had taken on too much risk with too little regulation and careless lending practices. And when things went wrong, it all came crashing down. After 2008, everything changed. Banks became stricter, regulation increased, and lending standards tightened. And as a result, it became much harder for small businesses, real estate developers, and even large corporations to get loans from traditional banks. And that's exactly where private credit stepped in, not as a backup but as an opportunity. So private credit markets are often described as the shadow version of banks. Firms like Blackstone, Apollo, and Blue Owl lend money direct to businesses, that bypassing traditional banks entirely. No banks, less regulation, and higher interest rates. Sounds attractive, but it isn't. So these firms aren't using their own money, and here's the part most people don't realize. Some of this money could be coming from retirement funds, pensions, or even indirectly your investments. And here's how it works. So your money goes into a fund, that fund lends it out to companies, and in return, you earn higher returns. At least that's how it works when everything is going well. But right now, things are not going well. Blackstone, one of the largest alternative asset managers in the world, recently faced a record wave of withdrawals from its $82 billion credit fund. Investors wanted their money back fast, but there's a problem. The money wasn't liquid, so Blackstone had to limit withdrawals, restricting how much investors could take out. And it didn't stop there. Blue Owl suspended redemptions in one of its retail funds. And also BlackRock also began tightening withdrawals. That's when the situation started getting serious. Because now we are seeing the real problem. Investors want their money back. But the companies that borrowed that money can't repay it quickly. And as pressure builds, valuation drops, stocks falls, and you can see here in BlackRock, etc. Think of the economy like a massive chain of dominoes. Each dominoes represent something: loans, companies, jobs, people spending. And the important thing is they are all connected. So when one falls, it doesn't stop there. It keeps going. So where it all begins. Private credit funds like Blackstone or Apollo are constantly lending money to businesses. Their money is like fuel. It keeps companies running, expanding, and surviving. But now imagine this. Investors suddenly want their money back. Funds don't have enough cash available, so they slow down or completely stop new lending. At first, this doesn't look like a big problem, but this is the first domino. The second domino is companies get stuck. So most people think companies take a loan and that's it. But that's not how it works. Companies are always rolling over debt. They repay old loans, replace them with new loans. And this is called refinancing. Now imagine what happens when that stops. A company has a loan due, but no new loan is available. And they don't have enough cash to repay it. Now they are stuck, and when companies get stuck financially, they don't wait, they react immediately. So now moving toward the third domino, that businesses go into survival mode. Once companies feel pressure, their mindset shifts from growth to survival. And survival means cutting anything unnecessary. So they start freezing hiring, canceling expansion plans, reducing budgets, and cutting employees' cost. Because for them, staying alive is more important than growing. And the fourth domino is layoff begins. So this is where the problem becomes real. Not just a number on a screen, but actual people. Employees lose jobs, income stops or reduces, and financial stress increases. And here's the key. Even people who still have jobs starts becoming more careful because uncertainty spreads fast. And fifth domino is the silent killer. So now zoom out to the entire economy. If millions of people lose jobs, fear losing jobs, or feel financially insecure, they all start doing the same thing, spending less. They delay buying cars, phones, houses, even basic upgrades. They save more and spend less. And this is critical because one person spending is equal to another person income. Now the effect multiplies. When people spend less, businesses earn less revenue, profit drop, more companies start struggling. So what do those companies do? They also cut cost. They also lay off employees, and now the cycle repeats itself again and again and again. And why this is so dangerous? Because it doesn't start with the whole economy collapsing. It starts quietly, one corner, one market, one problem. And in this case, private credit, but because everything is connected, it spreads like a chain reaction from loans to companies to jobs to spending less, and entire economy collapses. The system today is built on constant flow of credit. Money needs to keep moving. Loans needs to keep rolling and confidence needs to stay intact. The moment that flows slows down, pressure starts building. And if it stops suddenly, the system doesn't crash instantly, it unravels step by step. When lending slows down, businesses get stuck. People lose jobs, spending falls, and that's how a small crack turns into a full economic slowdown. The economy runs on credit like the human body runs on oxygen. So you don't notice it when it's flowing, but the moment it stops, everything begins to shut down. Now, normally, when something starts breaking in the economy, there's one institution that steps up to stabilize everything: the Federal Reserve. Think of the Fed as the system's emergency support. Whenever markets panic, whenever businesses struggle, and whenever liquidity disappears, the Fed usually does two very simple things. First, they lower interest rates. That makes borrowing cheaper. Companies can take new loans, refinance old ones, and keep operating. Second, they inject money into the system. And this is what people call printing money or quantitative easing. More money flowing through the system means more stability, more confidence, and usually market recovers. And for years this worked. And every time something broke, the Fed stepped in. And the system kept moving, but this time it's different. Right now, the Fed is facing a situation where every option comes with a cost because they are stuck between two problems happening at the same time. The first problem is inflation. Even today, prices across the economy are still elevated. Food, fuel, housing, everything is more expensive than it used to be. Now, here's the issue. If the Fed lower interest rates or print more money, that puts even more money into the economy. And when more money chases the same goods, prices go up again. So if the Fed tries to help the system too aggressively, they risk reigniting inflation all over again. But at the exact same time, there's a second problem building underneath the surface. And that is the economy is starting to slow down. Companies are under pressure. Credit is tightening, hiring is weakening, and in situations like this, the economy usually needs support. It needs cheaper money, it needs easier credit, it needs exactly what the Fed normally provides. So now the Fed is stuck in a very difficult position. If they step in to support growth, they risk making inflation worse. But if they hold back to control inflation, they risk letting the economy slow down even more. And this is where it connects directly to the private credit problem. Because what's happening in private credit right now is essentially a liquidity issue. Money isn't flowing as easily as before. Funds are becoming more cautious. Lending is slowing down. Investors are trying to pull money out. And normally, this is exactly the kind of situation where the Fed would step in, inject liquidity, lower rates, and calm everything down. But now, if they do that, there's a real risk that inflation spikes again, especially with external pressures like rising oil prices and the Iran-US war that's happening right now. So instead of having a clear solution, the Fed is forced to be careful because the oil prices are rising, and whenever the oil prices rises and get doubled, the next year the recession follows. And that's what makes this situation different. It's not just that there are risks in the system, it's that the main institution that usually fixes those risks can't act as freely as it used to. So think of it like this. The Fed is like a firefighter. In the past, whenever there was a fire, they could just pour water on it and put it out. But now the building is filled with electrical wiring, and using water the wrong way could make things even worse. So they hesitate, they wait, they try to balance both sides. And while they do that, pressure can continue building inside the system. Which means if something starts to break, it might not be stopped as quickly or as easily as it has been in the past, and that's what makes these times different. The system might need help, but the Fed can't respond the way it used to. So when you put all of this together, a $3 trillion private credit market, money getting locked, companies struggling to refinance, and a Fed that can't easily step in. So you start to see the bigger picture. This doesn't mean a crisis is guaranteed, but it does mean one thing: the system is under pressure, and the cracks are starting to show. And if history has taught us anything, it's that financial crises don't start when everyone is watching. They start when almost nobody is.